Okay, let's continue our discussion on raising equity capital. So in the last class, we discussed equity financing for private firms. And we talked about several main sources of financing: angel investors, VC firms, institutional investors, and corporate investors. And we also talked about some valuation stuff. So we discussed these several sort of relationships, right? So how post-money valuation and pre-money valuation are related and how to calculate percent ownership. Today we discuss two topics. The first is IPO, the second is SEO. And then you can see that these topics are really arranged according to a timeline, right? So basically, first, your firm will start as a private firm, and after obtaining multiple rounds of financing, you will file for initial public offering, and after becoming a public firm, you could use a seasoned equity offering to raise more equity capital. Okay, so first, what is IPO? Well, this is easy to understand, right? Because you can see that you have basically three words here. The first word, initial, means that's the first time you sell your equity stake to public shareholders. Public means you're going public. That is, you will become a public firm. Offering means you offer your firm's ownership for equity capital from future shareholders. Okay. So why do firms want to file for IPO? Well, there are several advantages. The first one is early investors, such as VC firms. They want the firm to file for IPO. The reason is because these early stage investors, they want to cash out, right? So if the firm files for IPO, then these early investors' shares can be traded, so they can sell their shares in the equity market, and then these early stage investors can exit their investment. And then the second reason is public market is essentially a very large capital pool. So if you're a public firm, then it's much easier for you to raise a large amount of capital. So here we have this example of real networks. If you compare the scale of equity finance, you can see that in the beginning, real networks last round of private financing raised about $30 million. And then when it filed for IPO, it raised $43 million. So you can see that this is a large amount compared with $30 million. And then 2 years later, it filed for SEO, that is a seasoned equity offering. This time, the firm raised additional $267 million. So this is even larger, right? It's larger than the combined number of the previous round private financing and the IPO. But there are also some disadvantages. The first is there are some corporate governance issues. Once you become a public firm, you will have a lot of shareholders. And these widely dispersed shareholders make it very difficult to monitor the firm's management, including CEOs and other C-level executives. And then the second disadvantage is the compliance cost. Because if you're a public firm, you have to subject yourself to stricter standards. And this is costly. For example, if you're a public firm, you have to disclose your financials each quarter, right? And that is a costly process. Now, let's talk about what types of offerings a firm can use when it files for IPO. And this essentially asks how an underwriter will sell shares. Here, an underwriter refers to an investment bank which manages the firm's equity issuing. For example, if you're the CEO of a firm and your firm wants to file for IPO, then you will hire Morgan Stanley as your underwriter. In this case, Morgan Stanley will be in charge of managing your security issuance. Here the question, what types of offering refers to how the underwriter will want to sell shares. So there are several different types. So the first type is best effort basis. In this case, the investment bank will try its best to sell your shares, but there is no guarantee your shares will be sold. Instead, the underwriter will try to sell the share at the best possible price. This type of offering is more common for smaller IPOs, and it also possibly come with a all or long caveat. That is, either all of the shares will be sold or the deal will be canceled. And the second type is called firm commitment. Basically, it means that the underwriter will commit to this IPO. So how the underwriter can commit itself? Basically, the underwriter will try to guarantee that it will sell all of the shares at the offer price. So to be more specific, the underwriter will purchase all the shares at a slightly lower price than the offer price. And then the underwriter will be in charge of reselling these shares. So, for example, if the offer price is $10, then possibly the underwriters will buy all shares at $9.5 from the firm. And then the underwriter will try to sell all these shares at $10 offer price. So clearly you can see that there is a $0.5 per share profit for this underwriter in this example, right? So this profit is called underwriting spread. Mathematically, underwriting spread equals offer price minus the underwriter's price, right? So it's really this price difference here. For example, in the real networks example, the underwriting spread was $0.875 per share. It's about 7% of the offer price. Now, you might think, well, it seems that firm commitment is fantastic because the underwriter serves as a reseller and it can earn money from the underwriting spread, right? But there is some risk in this type of offering. For example, the offer price for BP, so this is essentially a oil firm, right? So the offer price for BP was set just before October 1987. However, after setting the offer price, there was a huge stock market crash. And then the actual offering occurred after the crash, right? So you can see that in this case, the underwriter will suffer a huge loss. You can see the number here. At the end of the first day's trading, the underwriters were facing a loss of $1.29 billion. Okay, and then the third type of offering is called Auction Ipo. So it's a more recent phenomenon. So basically, in this case, firms will sell new shares directly to the public by using auction. More specifically, this is called Dutch auction. So basically, the underwriter will take bids from investors, and then the underwriter will try to aggregate these bids. So what the underwriter will do is the underwriter will set the price at which the number of bids at or above that price equals the number of shares. So it's really a balance of demand and supply, right? And in the end, all winning bidders will pay the offer price. So even if their bid was higher. Now let's see a example which will tell you in a very clear way how Auction Ipo works. So let's say Fleming Educational Software is selling 500,000 shares, and it uses Auction Ipo. At the end of the bidding period, Fleming's investment bank has received the following bids. And you can see that at each bid, you can see the quantity demanded, right? So you can see, if you recall what you have learned in introductory microeconomics, this is essentially a demand curve. So clearly the investment bank can look at this demand curve and determine at what price the market can clear. That is, at what price quantity demanded equals quantity supplied, right? So it's a very easy economic problem. Okay, now let's see what's the question here. Oh, the question is, what will the offer price of the shares? Now, if you look at the quantity supplied, you can see that it is 500,000 shares. And then if you look at the demand curve, you can see that at the price of $8, quantity demanded should be, so let's call this QD, right? Quantity demanded would be 2500. And at 7.75, quantity demanded would be 25,000 plus 100,000. So it's 125,000. And let's continue this process. So at 7.50, the quantity demanded would be, well, you will pretty much add up these three numbers. It's 20,000, right? So if you continue to do this, you will find out at 7.25, we will have 35000, and at 7, we will have 500,000 shares. So you can see that at $7, quantity demanded equals quantity supplied. This pretty much means the offer price should be $7, right? And we have learned here that all winning bidders, they will pay this offer price, even if their bid was higher. It means that for this guy, right? So he's willing to pay $8. However, in the end, he will only pay the offer price of $7 to get this number of shares. Okay. Now let's talk about how IPO works. IPO is a very complicated process, and the textbook has, I guess, about 10 pages discuss how the IPO process works in much details. Here I will just briefly talk about the mechanics of a IPO, and if you're more interested in how IPO exactly works, you could read the textbook. So first, for many IPOs, especially larger ones, the firm will generally have several investment banks serve as underwriters. And then there will be a lead underwriter, the leader, right? So this lead underwriter will provide most of the advice and service. And then this lead underwriter will lead a group of other underwriters. And the several underwriters, they work together to help market and sell the shares. Okay, so here you have a table of investment banking firms in Canada and in the US and in Europe. This is interesting because generally for undergraduate in finance, a job at a investment bank is considered a really great opportunity because your pay is generally quite high and your exit options are actually quite good after working at a investment bank for several years. Okay, so let's see how a IPO works. So first, the investment banks, they will work with the firm to do the valuation process, right? This is obvious. So through this valuation process, there will be a price range. And the method will be either or both discounted cash flow analysis or using comparable firms. And after this valuation period, to get a price range, the senior management of the firm and the investment bankers, they will travel and they will promote their firm to some large customers, such as pension funds or mutual funds. This is called road show. And you can see that this name is very intuitive, right? And then there is this book building process. So basically, during the roadshow, the senior management and the investment bankers, they will try to gauge, they will try to understand potential customers' interests. So after customers expressed their interests in the IPO, investment bankers, these underwriters, they will come up with the offer price. Okay, so let's see this example here. So it's called valuing a IPO using comparables. So essentially, we will look at several valuation ratios or valuation multiples, and then we will use these valuation ratios as a basis to estimate the value of the IPO. So Wagner had revenue of $325 million, and its earnings are $50 million. And before IPO, Wagner's investment bankers, the estimated value of the firm using comparable firms. In each case, the ratios are based on the IPO price. So we have these four comparable firms, and we have their PE ratio and their price revenue ratio. The question, after the IPO, Wagner will have 20 million shares outstanding. The question is, we need to estimate the range of IPO price for Wagner using the PE ratio and the price revenue ratio. So this is pretty simple, right? So the first step is, after getting data on the PE ratio and the price revenue ratio for these comparable firms, you will want to try to estimate Wagner's PE ratio and price revenue ratio. So assume here we are just using a very simple process, right? So we are basically using this simple average here. We're just looking at the average of these ratios. And we find out the average PE ratio of these comparable firms is 21.2, and the average price revenue ratio for the comparable firms is 0.9. And now based on these two numbers, that is these two averages, we will try to estimate the firm Wagner's IPO price. And let's say we first start with PE ratio, right? So PE ratio is 212, and this basically P equals to 1.2 times E. Here E refers to earnings, and we know that the firm has earnings of $15 million. So we have 21.2 times 15. Okay, let me use my calculator. So 21.2 times 15. So this is 318. And we also have 20 million shares, right? So the stock price, well, let's call this offer price because we're dealing with a IPO. So offer price is 318 divided by 20, which is 15.9, right? And then we could also use this price revenue ratio. Price revenue ratio is essentially a PS ratio. But let me see. Yeah. So we have the number of 0.9. So P equals 9 times S. S refers to sales. And Wagner has a sales number of $3 to $5 million. Okay, I just copy the answer from the answer key. This should be $292.5 million. And then again, the offer price is easy to solve. So we would just use this number as the numerator and divide it by 20 million shares. So this gives us a price of $14.63. So you can see that with these two ratios, we get a range for the offer price, right? So the lower end is $14.63, and the higher end would be $15.9. The lecture note actually has some unrequired pages, right? So you can see that if you're interested, you can read these different pages on the mechanics of a IPO. Okay, now let's talk about several IPO facts or observations from data. The first interesting fact is, on average, IPOs are underpriced. Second, the number of IPOs is highly cyclical. Here the word cyclical means there is a boom and bust cycle. So if economy is good, we will see a lot of IPOs. And if economy is bad, we will see very few IPOs. And the third fact is the costs of the IPOs are very high. The fourth is the long-term performance of IPOs is generally poor. Okay. Oh, by the way, the word fact is not super good. I guess it's better to say for IPO observations, because essentially these are research results obtaining from looking at the data. And also don't consider these as like laws, right? These are not laws. Maybe after several years, these results will change. Maybe you will see that the long-run performance of IPOs become better, right? It is no longer poor. That's possible. Okay, so first, what is underpricing? Well, it's actually a very interesting observation. So basically, if you look at data, you would see that underwriters, they set the offer price low such that the average first day return is positive. So the first day return is calculated as the first day's closing price divided by the offer price. For example, if the offer price is 100 and after the first day's trading, the stock closes at 150, then you can see that the first day return is 50%. The data tells us if you look at IPOs, then generally, on average, the first day return is positive. So this is interesting, right? Because this implies there is some underpricing here. Well, think about this. If the stock's offer price is 100, but it closes at 150, then why didn't the underwriters set a offer price of 150, right? Instead, it actually set a lower price compared with the first day's closing price. So there is underpricing. And you can see that this underpricing will benefit both underwriters and investors. So for underwriters, if it sets the offer price lower, then it will be easier for the underwriter to sell these shares. This is especially important for an underwriter with firm commitment, because we just learned if this type of offering is firm commitment, then the underwriters will actually serve as a reseller, right? It will buy all the shares from the firm and resell these shares at offer price. So by setting a lower offer price, underwriters will have a easier time to sell these shares. This will reduce underwriters' inventory risk. And this will also benefit the investors who bought the shares at the offer price. Right? This is easy to understand. Basically, if you bought shares at $100 offer price, and if the first day's trading ends at $150, then obviously per share you will earn $50. But you can see that there will be costs, right? To be more specific, early stage investors, that is pre-IPO shareholders, they will bear the cost of underpricing. Because essentially, let's say offer price is 100 and the price after the first day trading is 150. In this case, you can see that the pre-IPO shareholders, they will suffer, right? Because they're selling their existing equity at a price of 100 instead of 150, right? So they lose $50. And you can see that this underpricing is actually a very universal phenomenon across different countries. And here we have a table which shows you the scale of underpricing from different years. But what you can see here is Canada has somewhat small level of underpricing, right? It's about 7%. And then for US, the underpricing is more severe. It's about, I guess, 17%. And then China, across all these countries, has the largest underpricing at over 120%. This is huge, right? It basically means if you bought the shares at the offer price, then for one day you could earn 120%. Now you might wonder why there is underpricing, right? A obvious, I mean, a quite obvious way to remove this underpricing is all investors could rush to buy IPOs, right? So why don't all investors they rush to buy IPOs? Well, interestingly, there is this winner's curse. So basically, if you're the investor and if you want to specialize in investing in IPOs, you will find that for good IPOs, your investment will be rationed. And for bad IPOs, then you will become fully invested. Basically, this means if you want to invest in every IPOs, and let's say for every IPO, you will want to invest $1,000, then you will find out for good IPOs, you will only be able to invest $100. But for bad IPOs, you will for sure invest $1,000. This is a winner's curse, right? It basically means that you're a winner because you can buy these IPO shares. But this is a curse because it means that if you can buy all the IPO shares you want, then potentially this is a bad IPO. Very quickly, you will see an example which shows you why this is the case. But we can first talk about some intuition here. So the intuition is actually pretty easy to understand. If it's a good IPO, then generally the demand for the IPO will be larger than the supply, which means there will be some allocation process or some sort of lottery, which means the allocation of the shares for IPO investors will be rationed. That is, if you want to spend $1,000 to buy a good IPO, in the end, you could only buy $100. And then if it's a bad IPO, then the demand is actually smaller compared with supply. In this case, all your orders will be filled, which means if you want to buy $1,000, then you will actually buy $1,000. However, you're investing in a bad IPO. So it's an interesting result, right? It basically means that you will invest more in bad IPOs and you will invest less in good IPOs. So in the end, you could potentially lose. Okay, let's see this really interesting example. So let's say suppose you're a customer of a certain underwriter, so Thompson Brothers. On each deal, you will commit to buy 2,000 shares. And if the shares are available, you will get them. But if the deal is hot, then your allocation of shares will be rationed. And this rationing will be in proportion to the oversubscription. Let's say your market research shows that typically 80% of the time, Thompson deals are oversubscribed 16-1, which means for 16 orders, you can only fill one order. And the price increases on the first day by 20%. So this is a good IPO. However, 20% of the time, deals are not oversubscribed. In this time, on average, the price will decline by 5% on the first day. Now we have two questions. The first is, what is the average underpricing of a IPO? Second, what is your average return as an investor? So this is really a probability question, right? So if you have learned statistics, then you should figure out this quite easily. First, what is the average underpricing? So you can see that 80% of the time, the first day return would be 20%, right? And 20% of the time, the first day return would be minus 5%. So here you can find out the expected return of a IPO, right? So it's essentially 80% times 20% plus 20% times minus 5%. And this will give you, I think it's 15%, right? So the average underpricing of the IPO is 15%. And here you can see that on the IPO level, there is indeed underpricing. If you can get in every IPO, then you earn this 15% return. However, you can see that for an individual investor, you cannot get in every IPO, right? Because for every 16 orders, you can fill one order, right? So in this case, you can see that first, let's say it's a good IPO. We know that for 16 times, you can get in like one time. So the expected return here is 1 over 16 times 80% times 0.2. And then for a bad IPO, you are getting every time. So it's just 0.2 times minus 0.05. And this is just 0%. So you can see that this is an interesting result because you can see that on the IPO level, there is positive return, but on individual level, there is zero return here. And you can see that the major difference is really this 1 over 16, right? It's really because of this number. And this number is easy to understand. It basically means if it's a good IPO, then your expected return will be smaller because you can only get, because for 16 orders, you can only get one order filled, right? If you find the approach to the second question is purely based on probability. And if you don't like this, then we could use a easier to understand approach, right? Let's use this easy approach. It's easy, but it's longer. So I will follow the textbook approach. So you know that every time you have to buy 2,000 shares, and you know that if it's a hot IPO, then for 16 orders, you can fill one order. This basically means that if it's a good IPO, you can buy 2,000 divided by 16 shares. I don't know what's the number here. I think it's 20. No, it's not. So 200 divided by 4. I think it's 125. Let me check the lecture note. Yeah, it's 125. So let's assume the IPO price is $15, right? And then in this case, you can see that. So let's say assume $15 IPO price. Now you can calculate your expected return. So if you buy 125 shares, so if you buy 125 shares, and per share price is 15, and if you can get a 20% return, then you can see that from a good IPO, your return would be, I think it's three. It's $375. Now let's look at a bad IPO. Right? For a bad IPO, you were getting every time, and you will fully invest it. You will buy 2,000 shares, and in this case, per share price, let's assume it's still $15, and you will lose 5% on the first day. So your profit or your loss would be this amount times minus 5%. And then you can see that this is let me see. This is minus 1,500, right? And now you can see that your expected profit would be, so for 80 times you will get into this good IPO, so you earn $375, and then for 20% of the time you will get into a bad IPO, so you will earn minus $1,500. So this will give you, you can see that this will give you a profit of just zero. So again, you can see that you get a zero profit. Okay, the second interesting observation about IPO is the cyclicality pattern. It basically means that if the economy is good, there will be a lot of IPOs. And if the economy is bad, then we will see very few IPOs. So, for example, between 2000 and 2003, that is, after the burst of the dot-com bubble, the decline in IPO was more than 75% in dollar value. So this figure tells you the cyclicality pattern of IPOs. So you can see that, so this red line tells us the number of IPOs, and the blue bars tell us the dollar volume of IPOs. So what you can see here is from early 90s leading to the peak of the dot-com bubble, you can see that there was this constant increase in IPO, right? The constant increase in IPO. And then after the burst of the dot-com bubble, both the number of IPOs and the dollar volume were declining sharply. Right? You can see there was a sharp drop. And then the IPO market gets recovered, right? So this leads to 2008. And then in the financial crisis, you can see that the IPO volume drastically reduced. And then the market recovered in March 2009. So after that, you will see an increase in the volume and the number of IPOs. The third observation is the cost of the of IPO is actually quite high. So the typical underwriting spread is quite large. It's about 7% of the issue price. So roughly speaking, it means that if the offer price is $100, then the firm has to pay $7 to the investment bank. If you look at data, then this percentage generally decreases with IPO size. This is easy to understand, right? So if IPO size is larger, then investment banks will have the incentive to reduce the percentage charge, because if this IPO size is large, even with a smaller percentage charge, the total amount charged by the investment bank will be large. And if you look at the data, you will see that the degree of this decrease is actually quite small. So if you look at the data here, let's focus on the red bars, these bars. And the horizontal axis gives us the size of the IPO, right? And the vertical bar tells us the percentage cost. So what you can see here is you get this smooth relationship. As the size increases, the percentage charge becomes smaller, right? For a IPO size which is smaller than $10 million, the percentage was about 16%, which is really high. And for a large IPO, let's say larger than $500 million, the percentage charge is about 7%. So indeed you can see that the percent charge decreases with IPO size. But you can see that this kind of decrease is very small, especially after $10 to $20 million of IPO size. You can see that here. So this is the IPO size was $10 to $20 million. So here we get a number of 12%. And then if the IPO size doubles, the percentage cost only decreased by like 2%, right? So you can see that the decrease in the percentage is actually very small or very slow as the IPO size increases. Now, why do we see this result? Well, one possible reason is there is some reputational concern here. It's actually a very interesting reason. So basically, the reason here is by charging a higher fee, an investment bank can tell its competitors, hey, I am a high quality investment bank. That's why I can charge a higher fee. So the opposite to this kind of reasoning is, as a investment bank, if you charge a lower fee, then you might risk signaling that you're not the best underwriter compared with your higher priced competitors. Okay, the fourth result about IPO is this long-term underperformance. So if you examine IPO performance, then you can see that IPOs, they generally underperform the general market after 3 to 5 years. That is in the long term. The explanation to this is, the first reason is market timing. That is, firms, they will only want to file for IPO when the firm is overvalued or the market is overvalued, right? This is easy to understand. It basically means that you will want to sell when you're overvalued. This basically implies that, well, since you're selling only when you're overvalued, then after long run, people will actually discover your true value. So investor will find out, well, this firm was overvalued. So in the long run, your performance would be lower. And then the second reason is related to real option. And I didn't teach real option in this semester, but still, we could just get some intuition here. The second explanation is called exercising growth option. So basically it says if the firm files for IPO, then it will exercise its growth options. If you don't like growth options, then you could consider that if the firm files for IPO, it will use the money to finance new project. And this will reduce the firm's risk. This will reduce the firm's return. Right? So this is a risk-based explanation because according to CAPM, we know that if a firm has lower systematic risk, then its return should be lower, right? So here, the second reasoning basically says that if the firm files for IPO, then by investing in new project, it will exhaust its existing growth options. So its systematic risk will be lower, then its expected return should also be lower. Okay, great. Now let's talk about the last section of this chapter. So this is called seasoned equity offering. And you can see that this is really in comparison to the initial public offering, right? It's seasoned because SEO, seasoned equity offering, refers to the case a public firm offers new shares for sale after its IPO. So the word seasoned really means after IPO. And the SEO process was somewhat similar to the IPO process, except that the price, the share price already exists. So the price setting process for SEO is not necessary. Now let's talk about the mechanics of a SEO. We'll focus on two types of offering. The first is called cash offer. So in this case, new shares will be offered to the public. It's called cash offer because it basically means anyone with cash can buy the new shares. The second one is called rights offer. In this case, new shares will only be offered to existing shareholders. So you can see that it's called rights offer because you need the right to buy the new shares. If you compare cash offer versus rights offer, then what you can see here is rights offer actually protect existing shareholders from underpricing. This is easy to understand because under rights offer, because new shares will only be offered to existing shareholders. You can assume that even new shares are underpriced. The benefit of underpricing will be absorbed by existing shareholders, right? So in the end, the rights offer can protect existing shareholders from underpricing. And an empirical fact is, in Canada and the US, most offers are cash offer. In the UK, most are rights offer. So now let's see a very simple example which shows you how the rights offer works. So let's say you're the CFO of a firm which is worth $1 billion and the firm has 100 million shares outstanding and the shares are trading at $10 per share. You need to raise $200 million using a rights issue. And each existing shareholders will have one right for one share. Essentially, it means if you have 100 million shares, then there will be 100 million rights. And now you can have two forms of rights offering. The first is you can require 4 rights to purchase one share, and the share price would be $8 per share. Or you can require 5 rights to purchase 2 shares, and the price is $5. Now let's assume all shareholders will exercise their rights to buy shares. Now we have 3 questions. First, what approach will raise more money? Second, what is the firm's value and share price after the SEO? Third, verify that all shareholders will want to exercise their rights. Okay, now let's finish these questions one by one. First, which approach will raise more money? In this case, you can see that you will essentially calculate what amount of money you can raise from these two different approaches, right? So let's consider the first approach, right? In the first approach, you will require 4 rights to purchase 1 share. So in this case, you will essentially raise this amount of money, right? So you will use 100 million divided by 4 because you have 100 million rights, right? Because we just discussed. Okay, let me see where it is. Oh, so each existing shareholders will have 1 right, and because we have 100 million existing shares, so we will have 100 million rights. And then this means 100 divided by 4 will tell us we can actually issue 25 million shares, right? And the per share price is $8. So in this case, we will be raised $200 million. Now let's discuss the second approach. 5 rights to purchase 2 shares. In this case, you will issue this amount of shares. That is 100 divided by 5 times 2, right? And the per share price is 5. So you'll see that again, you will be able to raise $400 million. And under these 2 approaches, for the first approach, you will issue 25 million shares. This is essentially 100 divided by 4. In the second approach, you will issue 40 million shares. This is essentially 100 divided by 5 times 2, right? Now, the second question is, what is the firm's value and share price after the SEO? So here, the firm initially has a value of $1 billion. And then the firm will raise $200 million, which is $0.2 billion. And if you recall the post value and if you recall the pre-money and post-money value of a firm, then you can see that the post-money valuation equals pre-money valuation plus the amount raised. So you can see that the pre-money valuation was $1 billion. The amount raised was $0.2 billion. So you can see that the firm's value will increase to $1.2 billion. Right, so it's $1.2 billion. And the share price after the SEO. Well, under both approaches, the firm's value will be the same, right? It's always $1.2 billion. But the share price will be different, which is easy to understand because for the first approach, the firm had to issue 25 million shares. And for the second approach, the firm needs to issue 40 million shares. So the share price would be, in the first approach, it's 1.2 billion divided by, okay, let me use million. So it's $1,200 million divided by, so how many shares do we have here? So we have 100 million shares initially, and additionally, we have 25 million shares. So we have 1 to 5 million shares. And this would be, so this would give us the number of, 9.6. And for the second approach, we have the same firm value, 1,200, divided by 100 plus 40. So it's 140. And this gives us a stock price of 8.57. 8.57. Okay, now the third question is, verify that all shareholders will want to exercise their rights to purchase shares. So in this case, you will see that for the SEO, for the first approach, the offer price was $8. And after the SEO, the stock price will be 9.6. So obviously, existing shareholders will happy to exercise their rights. And then in the second approach, if they exercise their rights, they will purchase shares at $5. And the after SEO price would be 8.57. So again, these shareholders will be happy to exercise their rights. Okay. Now, the price reaction. So here we want to examine how stock market will react to the news of a seasoned offering. And the finding is generally share price will decrease if there is a SEO. So if you look at the graph here, what you can see here is for the horizontal axis, we have years. And then for the vertical axis, we have the risk-adjusted returns. And then for these different curves, this curve is for a large firm. This is for medium firm. This is for small firm. And what you can see here is, so what you can see here is the performance of SEO was actually negative, right? And you can see that it's more negative for small firms and it's less negative for large firms. So what's the explanation to this? Well, for this SEO underperformance, we can have this similar explanation to IPO underpricing. Sorry, it's not IPO underpricing. The lecture note here is incorrect. It should be IPO underperformance. So the explanation to the SEO underperformance is similar to the explanation of IPO underperformance. Again, we have two reasons. First is market timing. That is, firms, they file for seasoned equity offering when their equities are overvalued. So obviously, in the long run, overvalued equity will give you lower return. Then the second one is again about real option. That is, if the firm raises more capital through seasoned equity offering, then the firm exercises its growth options, and this will make a firm less risky. So if the firm's systematic risk reduces, then its expected return should also reduce. Okay, last we talk about the cost of seasoned equity offering. So the underwriting cost is about 5%, and you can see that the seasoned equity offering is cheaper compared with IPO, because we learned the typical cost or the average cost of IPO is about 7%. This is pretty easy to understand because seasoned equity offering is simpler compared with IPO. We learned that for seasoned equity offering, we have existing share price. So the price setting process is not needed. This will save both the firm and the investment bank some time. And another fact is rights offering is generally cheaper compared with cash offering. And then this bears the question why most offers in Canada and in the US are cash offers, despite cash offers are more expensive compared with rights offering, right? Well, the reason for this is in cash offering, investment banks, they would take a larger role. So investment banks can have some certification benefit. So essentially, with a investment bank involved, the public, the shareholders, they will be more confident to this firm's equity offering. So the equity offering's quality is more credible to the public. And then the second reason is about asymmetric information. So if the asymmetric information is large, then the benefit of certification from investment bankers will also be large. And this benefit could actually overcome the cost difference. So if you recall corporate finance 2, we discussed the effect of asymmetric information on equity. The result there was equity will be underpriced because of asymmetric information. So you can see that if a firm hires a reputable investment banker to do this cash offer, then the investment banker can use its reputation to reduce this asymmetric information, which means the underpricing can be reduced. So the benefit of the underpricing could potentially be larger compared with the cost difference. Even cash offers are more expensive compared with rights offering. So that's why in Canada and the US, we'll have more cash offers. Okay, now let's review this chapter. First, what are the main sources of funding for private firms to raise outside equity? We mainly talked about 4 different kinds of sources, right? So the first is the angel investors. These could be wealthy individuals or successful entrepreneurs or even your wealthy uncle. And then we have venture capital firms. So these are firms which is a limited partnership, and VC firms, they specialize in early stage firms. And then we could also have private equity firms. Private equity firms, they're also incorporated as limited partnership. But PE firms, they're more likely to invest in larger and mature firms. Then we also have institutional investors and corporate investors. Second, what is a VC firm? Well, we just talked about this. Right? Third, what are some of the advantages and disadvantages of going public? Advantages. First, it offers the early investors a chance to cash out. Second, the second advantage is the public market is a large capital pool. So the firm is easier to raise large amount of capital by going public. And disadvantage is, the first is the corporate governance issue. That is, if you're going public, then you will have a lot of investors. And these dispersed investors will have a difficult time to monitor executives. The second disadvantage is compliance cost. So if you're a public firm, you have to subject yourself to a lot of compliances, right? So these compliances will cost you a lot of money. Fourth, list and discuss 4 IPO facts. Again, I don't like the word facts, so observations. So what is the first observation? Well, on average, there is underpricing in IPO. So this means the first day's return is generally positive for a IPO. And then the second one is there is this cyclicality in IPOs. That is, if economy is great, then we will see a lot of IPOs. If economy is bad, then IPOs dry up. And then the third one, there is long-term underperformance in IPOs. So that basically means that if you got into the IPO and if you hold it for 3 to 5 years, then on average you will lose money. And what's the fourth observation? There is this consistently high cost in IPOs, right? We learned it's about 7%, and this percentage declines very slowly with IPO size. What is the difference between a cash offer and a rights offer for a seasoned equity offering? So if it's a cash offer, then anyone with cash can buy the new equity. That is, the offer is open to the public. Rights offer means the offer is only open to existing shareholders, so you need to have the right to make the purchase. Okay, that's for today's class.